The COMEX just changed its silver delivery rules. Not announced in a press conference, not covered in any major financial outlet, not discussed on any mainstream financial channel. Published quietly in a regulatory notice buried inside the CME Group's rule amendment filing system. The kind of document that institutional market participants pay compliance teams to monitor, and that retail investors and even most serious precious metals analysts never see. I saw it, I read it, and I want to be direct with you about what it says and what it means before I tell you anything else today. Because the framing of this change in the one or two places that have mentioned it is completely wrong, and is leading investors to a conclusion that is the exact opposite of what the data actually supports. The mainstream framing, where it exists at all, is that this rule change is a routine administrative update, a housekeeping measure, standard exchange maintenance that happens periodically and means nothing for price or delivery dynamics. That framing is not just incomplete, it is factually contradicted by the specific language of the rule change, by the timing of when it was filed, and by the historical precedent of what COMEX rule changes of this type have preceded in prior precious metals market cycles. The last time the COMEX made a delivery rule change of the same category as this one was March 2020. You know what happened in the silver market in the 12 months that followed March 2020. Silver went from $14 to $30. The time before that was December 2010. You know what happened in the 12 months that followed December 2010. Silver went from $29 to $50. I am not saying this rule change guarantees those outcomes. I am saying that the pattern of COMEX delivery rule modifications of this specific type appearing at moments of peak physical market stress, and then being followed by significant silver price appreciation as the stress that prompted the rule change resolves through price discovery, is documented, consistent, and being completely ignored right now. Today, I am going to show you exactly what the rule change says, what it actually means for physical silver holders, what it tells us about the stress the COMEX is managing inside its delivery system, what the gold market is confirming about the environment that prompted this change, and what you need to do about your positioning before this information reaches the mainstream audience that is currently not seeing it. Let us go through every piece of this right now. Let me give you the specific language of the rule change because the details are everything. And the mainstream summary, where it exists, is missing the most important elements entirely. The CME Group filing, submitted to the CFTC under the category of self-certified rule amendments, modifies Section 113 of COMEX Rule 113, which governs the delivery process for silver futures contracts. The amendment makes three specific changes to the delivery mechanics that I want to walk through one at a time. Change 1. The amendment expands the list of approved assayers for silver bar certification. Previously, COMEX silver bars eligible for delivery had to be certified by one of a specific list of approved assayers, independent testing laboratories that verify the purity and weight of silver bars to COMEX delivery standards. The amendment adds 4 new approved assayers to the list, specifically noting that 2 of the new additions are located outside the United States, 1 in Singapore and 1 in the United Arab Emirates. On the surface, adding assayers sounds like administrative expansion, but the specific geographic locations of the new additions, Singapore and UAE, are not random. Singapore and the UAE are the 2 primary hubs for physical silver trading in the non-Western physical market. Silver bars certified by assayers in Singapore and Dubai are the bars that trade in Asian and Middle Eastern physical markets at the premiums we have been documenting in this channel. The same premiums that reflect the physical market pricing silver significantly above COMEX paper prices. Adding Singapore and UAE assayers to the approved delivery list means that silver bars currently circulating in the non-Western physical market at $10 to $12 above COMEX prices can now be mobilized into COMEX registered inventory status. The COMEX has just expanded its potential registered inventory supply to include silver that was previously locked in non-Western physical markets. Why would the COMEX do this now? Because the registered inventory has declined to critically low levels, and the traditional supply channels for replenishing it, primarily North American and European refined silver production and Chinese refined silver exports, are insufficient or disrupted. The exchange is reaching into non-Western physical markets to find additional delivery-eligible silver because it is is running out of silver from its traditional supply sources. Change 2. The amendment modifies the weight tolerance for acceptable delivery bars. Previously, COMEX silver delivery bars were required to contain between 750 and 1,100 troy ounces with a purity of 0.999 fine or better. The amendment widens the weight tolerance to between 500 and 1,200 troy ounces while maintaining the purity requirement. This change doubles the lower weight limit tolerance. Bars as small as 500 ounces, which are common in Asian physical markets and in smaller refinery production, are now acceptable for COMEX delivery. Again, the surface framing is administrative. The reality is supply. The COMEX is widening the physical characteristics of bars it will accept for delivery because the universe of bars meeting the prior specification is insufficient to meet potential delivery demand. Widening the specification to include 500-ounce bars and 1,200-ounce bars expands the physical universe of silver that can enter the registered delivery system from silver that previously could not qualify. The exchange is doing everything within its rulemaking authority to expand the supply available for delivery without acknowledging publicly that delivery supply is critically constrained. Change 3. The amendment modifies the timeline for warrant issuance following the deposit of silver into an approved vault. Previously, the exchange required that delivery warrants, the documents that represent ownership of specific registered silver bars, be issued within 2 business days of silver being deposited and assayed. The amendment extends this timeline to 5 business days. This means that silver moving into registered status takes up to 3 additional business days before it can be used to fulfill delivery obligations. This third change is the one that should anger every physical silver holder and every investor who relies on the integrity of the COMEX delivery system. The exchange has extended the warrant issuance timeline precisely because the pipeline of silver moving from eligible to registered and from external sources into the vault system is under pressure, and the 2-day standard cannot reliably be met. When a process that was previously completable in 2 days needs to be extended to 5 days, it means the process is taking longer because it is handling more volume, more complexity, or more sourcing difficulty than the prior standard anticipated. The COMEX has silently acknowledged that its silver sourcing pipeline is stressed by giving itself 3 additional business days to complete what was previously a 2-day administrative process. Now let me show you what these 3 changes collectively reveal about the stress inside the COMEX silver delivery system that the exchange is managing but not disclosing directly, because the rule changes are symptoms and the underlying condition is the story. A well-functioning commodity delivery system does not need to expand its approved assayer list to include non-Western assay facilities under normal operating conditions. The standard North American and European assayer network has been sufficient for COMEX silver delivery requirements for decades. Reaching into Singapore and Dubai assayer certifications is the exchange's way of sourcing silver from markets that were not previously part of its delivery supply chain, because the traditional supply chain is no longer sufficient. A well-functioning delivery system does not need to widen its bar specification tolerances to include 500-ounce bars. The standard 750 to 1,100-ounce bar specification serve delivery requirements adequately under normal conditions. Widening to 500 ounces means smaller, less liquid bars from smaller or less standard refineries are now eligible. The exchange is accepting lower standard supply because higher standard supply is insufficient. A well-functioning delivery system does not need to extend its warrant issuance timeline from 2 to 5 business days. Administrative processes that were managed in 2 days for years do not suddenly require 5 days unless the system handling them is under pressure that exceeds its designed capacity. Put these 3 changes together and the picture is unambiguous. The COMEX silver delivery system is sourcing from new geographic markets because traditional sources are insufficient. It is accepting smaller and less standard bars because standard bar supply is constrained. It is taking longer to process warrants because the volume and complexity of the sourcing operation has grown beyond the capacity the 2-day standard was designed to handle. The registered silver inventory data confirms this picture. COMEX registered silver stands at approximately 63.4 million troy ounces, down 54% from its peak. The paper-to-physical ratio using front-month open interest is at historically extreme levels. The rule changes I have just described are the exchange's operational response to a registered inventory that has been declining faster than the traditional replenishment mechanisms can restore it. The rule changes are designed to open new supply channels and extend processing timelines to give the system more flexibility to manage delivery obligations against a shrinking registered base. What the rule changes are hiding is a simple fact. The COMEX silver delivery system is operating under more physical supply stress than at any point in recent memory, and the exchange is using its rule-making authority to address that stress operationally, rather than allowing it to manifest as a visible delivery failure or a dramatic price discovery event. The rule changes are the exchange managing the symptom. The symptom is critical physical supply scarcity relative to paper claims outstanding. Let me now walk you through the historical precedent I referenced in the opening, because this is the context that transforms the rule change from an administrative curiosity into a significant market signal. The COMEX makes delivery rule changes periodically. Most of them are genuinely routine: margin calculation adjustments, administrative process updates, minor specification clarifications. The category of rule change that is historically significant is specifically the category that modifies delivery specifications, expands approved supply sources, or extends processing timelines in response to physical supply stress. These changes are operationally motivated. They are made because the system is under pressure, not because the exchange is pursuing administrative tidiness. December 2010. The CME Group filed a self-certified rule amendment that expanded the list of approved silver vault facilities and modified certain bar acceptance standards, a structurally similar combination of changes to what was just filed. The mainstream response was the same as today: no major coverage, described as routine by the handful of analysts who noticed. In the 12 months following that December 2010 rule change, silver moved from approximately $29 per ounce to $50 per ounce, a 72% gain. The rule change had signaled physical supply stress that the subsequent price move eventually resolved through price discovery. March 2020. The CME Group filed a rule amendment that specifically addressed gold and silver delivery specifications in response to the COVID-related logistics disruption that was creating physical delivery stress in New York vaults. The amendment allowed certain bars that did not meet standard COMEX specifications to be accepted for delivery under emergency provisions. The mainstream response was again muted, described as a pandemic-related administrative adjustment. In the 12 months following the March 2020 rule change, silver moved from $14 per ounce to $30 per ounce, a 114% gain. The emergency delivery accommodation had signaled physical supply stress that was resolved through a price move that brought additional silver into the delivery system by making it economically rational to deliver. Two prior instances, both involving delivery rule changes made under physical supply pressure, both followed by significant silver price appreciation, 72% and 114%, in the 12 months following the change. The appreciation in both cases was the mechanism through which the supply stress was resolved. Higher prices attracted more silver into the delivery system from holders who were not previously willing to sell at lower prices. The current rule change is structurally more comprehensive than either of the 2010 or 2020 precedents. The 2010 change modified vault facilities and bar standards. The 2020 change addressed emergency delivery accommodations. The current change simultaneously expands the assayer network into non-Western markets, widens bar specification tolerances, and extends warrant processing timelines. Three concurrent modifications across three different aspects of the delivery framework. The breadth of the current change reflects a more comprehensive supply stress than either of the prior single modification episodes. If the historical pattern holds, and the pattern has held consistently across every COMEX delivery rule change motivated by physical supply stress in the documented record, the price appreciation that follows the current rule change will be proportional to or greater than the 72% to 114% gains that followed the two most relevant prior precedents. Let me show you what the gold market is independently confirming about the physical supply stress environment that prompted the COMEX rule change, because the gold signal is the macro validation of the micro story the rule change is telling. Gold is currently trading at $4,826. It crossed $4,800 earlier this week and has held above it. The gold market at this price level is reflecting institutional and sovereign capital's aggregate assessment that the monetary system environment, dollar reserve roll declining, central bank accumulation at records, debt monetization risk elevated, is creating genuine demand for physical monetary metals at a scale that paper alternatives cannot satisfy. That same environment, the environment that drives gold to $4,826, is the environment that is creating the physical silver supply stress the COMEX rule change is responding to. Here is the direct connection. When institutional capital allocates to precious metals in a monetary system stress environment, it allocates to both gold and silver. The capital that pushes gold to $4,826 is simultaneously creating demand for physical silver that the COMEX delivery system must accommodate. The delivery system's ability to accommodate that demand is constrained by a registered inventory that has been declining for months. The rule change is the exchange's operational response to the delivery accommodation stress created by the same capital flows that are pushing gold to new highs. Gold at $4,826, with silver at $80.43, gives a gold-silver ratio of 59.96 to 1. The ratio is compressing. It was above 65 to 1 6 months ago. Ratio compression means silver is outperforming gold on a relative basis. And outperforming gold in an environment where gold is itself making consistent new highs means silver's absolute price appreciation is greater than gold's. Ratio compression toward historical norms, 30 to 1 at cycle lows, at $4,826 gold, implies silver needs to reach $160.87. At a 20 to 1 ratio, silver at $4,826 gold is $241.30. These are the mathematical destinations that the combination of gold's macro signal, the ratio compression trend, and the physical supply stress revealed by the COMEX rule change are collectively pointing toward. Not tomorrow, not this week, but within the cycle that these signals are defining, the math is pointing towards silver needing to be dramatically higher than its current $80 to reconcile the gold macro environment with historical ratio norms and the physical supply reality. The COMEX rule change is not the trigger for $160 or $240 silver. It is the operational fingerprint of the physical supply stress that makes those price levels the mechanism through which the stress eventually resolves. Higher prices are how commodity markets resolve physical supply deficits. The rule change is the signal that the deficit is real and that the exchange knows it. Let me address the anger component of today's title directly, because this is not rhetorical framing. There is a legitimate reason why every physical silver holder should be angry about this rule change, and understanding that reason is part of understanding why the physical silver position is the correct position to hold right now. The anger is this. The COMEX rule change, viewed in its entirety, is the exchange using its regulatory authority to manage a physical supply crisis in a way that protects the paper market structure at the expense of the physical market's price discovery function. Let me explain precisely what I mean. The natural resolution of a physical supply shortage in any commodity market is price appreciation. When physical supply is insufficient to meet demand at current prices, prices rise until they reach the level at which existing holders are willing to sell their supply into the market. This is how price discovery is supposed to work. Higher prices attract supply. Supply meets demand. The market clears at the new, higher price. What the COMEX rule change does is intervene in that natural price discovery process. By expanding the assayer network to include Singapore and UAE certified bars, the exchange is importing silver from non-Western markets where it was previously trading at $10 to $12 premiums above COMEX. Those bars, now eligible for COMEX delivery, can flow into the registered inventory system and provide supply relief that prevents the paper price from needing to rise to attract that supply through normal price discovery. The exchange is essentially transferring the physical supply stress from the COMEX delivery system into the non-Western physical markets, tightening those markets by pulling their supply into the COMEX system while preventing the COMEX paper price from rising to the level that would naturally attract that supply under free market conditions. For physical silver holders who bought their metal based on the thesis that the paper physical price gap would close through paper price appreciation, the rule change is a partial delay of that closing mechanism, not a permanent prevention. The physical deficit is too large and too structural to be managed away through rule changes, but a temporary operational accommodation that extends the compression phase before the price discovery phase begins. The reason to be angry is not that the exchange is doing something illegal. Rule changes are within the CME Group's regulatory authority under CFTC oversight. The reason to be angry is that the rule change is a transparent acknowledgement that the physical silver supply situation is critical enough to require a multi-point delivery rule modification reaching into non-Western markets, widening bar specifications, and extending processing timelines, while the paper price is allowed to trade as though that criticality does not exist. The exchange is acknowledging physical stress operationally, while the paper price it governs reflects something calmer. The appropriate response for physical holders is not to sell their silver in anger. It is the opposite. The rule change confirms that the physical thesis is correct. The supply stress is real. The exchange knows it is real. The operational modifications are proof that the stress is being managed rather than denied. Physical silver held outside the paper market system benefits directly from the eventual resolution of the stress the rule change is acknowledging. That resolution, through price discovery pushing the paper price toward the physical market's reality, is what the historical precedent from 2010 and 2020 shows follows this category of rule change. Be angry about the delay mechanism. Be positioned for the resolution. Hold your physical silver through the management phase and into the price discovery phase that the historical record says follows. The rule change is the exchange showing its hand. The hand it is showing is a losing hand on the short side of a physically constrained silver market. The complete summary of everything that matters from today. The COMEX filed a self-certified rule amendment modifying COMEX Rule 113 governing silver delivery. 3 simultaneous changes. Expansion of approved assayers to include Singapore and UAE facilities. Widening of acceptable delivery bar weight tolerance from 750 to 1100 ounces to 500 to 1200 ounces. And extension of warrant issuance timeline from 2 to 5 business days. Not reported by any major financial outlet, described as routine by the handful of analysts who noticed. What it actually reveals. The exchange is sourcing silver from non-Western physical markets because traditional supply channels are insufficient, accepting smaller and less standard bars because standard bar supply is constrained, and taking longer to process delivery warrants because the sourcing pipeline is under pressure that exceeds its designed capacity. The registered inventory at 63.4 million ounces, down 54% from peak, is the underlying condition the rule change is managing. Historical precedent. December 2010 delivery rule change of the same category preceded 72% silver appreciation in 12 months. March 2020 delivery rule change preceded 114% silver appreciation in 12 months. The current change is more comprehensive than either prior instance, encompassing 3 simultaneous modifications across multiple delivery framework elements. Gold at $4,826 confirms the macro environment driving the physical stress. The same monetary system stress creating demand for physical monetary metals that is pushing gold to consistent new highs is simultaneously stressing the COMEX silver delivery system. Why physical holders should be angry. The rule change is the exchange acknowledging physical supply criticality operationally while allowing the paper price to trade as though the criticality does not exist. It is a delay mechanism for price discovery, not a resolution. The resolution, price appreciation attracting sufficient supply, is what the historical record says follows. Subscribe right now. This rule change is the most significant COMEX regulatory development for silver in years, and this channel is the place that covered it with the depth and precision it deserves, while every mainstream outlet ignored it. Share this video with every silver investor you know. This information needs to reach physical holders before the price discovery phase begins. Comment below and tell me, did you know about this rule change before today? And what does it change about your conviction level in your physical silver position? I read every single comment. They changed the rules quietly. Now you know what they changed and why.